So how can I, as a financial advisor, say that the 60-40 portfolio is dead? Isn't that kind of the gold standard, particularly as people are getting older and they get closer to retirement? 60% stocks, 40% bonds. What's wrong with that, and why am I saying it's dead? Today's video, I'm going to share with you 3 reasons why I think the 60-40 portfolio is dead, and importantly, what you should do instead. Okay, so again, the 60 portfolio says 60% stocks, 40% bonds, and if you do that, you've done a good job of protecting your nest egg. That's what the thinking has gone. But as 2020 has shown us, and as I've always felt for my 20-plus tenure, the 60-40 portfolio only works if you have the right kind of bonds in your portfolio. In 2022, lots of people got hurt in a 60-40 portfolio. Their stocks were down, and shockingly to them, so were their bonds. And you know what? The same thing happened in the great financial crisis. So if we look and see during scary times, if the 60-40 portfolio is not protecting us, what should we do instead? Okay, so the first thing is we have to be really critical about the types of bonds that we have in our portfolio. Bonds are not necessarily less volatile, less up and down in price than stocks. Bonds can be every bit as volatile depending on the type of bond that you have. So that's the first thing, and I want to come back to that. But I also want to share with you my second point, which is I think we do ourselves a disservice when we call our portfolio 60-40. I think even if you have a portfolio like that, a much better thing, and the bonds are there to keep us from getting scared when the market's down and to buffer us from that volatility. But I think for most of us, a much better approach is to think about that 40% in bonds, to think about it, how many years worth of living, my living expenses, could my bond portfolio support? So rather than saying you're 60-40, I'd like you to say that, you know what, I have 3 years worth of living expenses in bonds. Say this to yourself, 3 years or 5 years or 7 years or 10 years. The more years of living expenses you have in bonds, for most of us, it gives us peace of mind. You know, who cares if the stock market's down 20, 30, or 40%? If we don't have to touch our stock portfolio for 3 years, 5 years, 7 years, or longer. In fact, if the stock market's down, it is a buying opportunity. So I say the 60-40 portfolio is dead, in part because I don't think it serves us well to think about it that way. Instead, I think years of living expenses gives us the most benefit of having that. Okay, so let's go back to the type of bonds. I said earlier, all bonds, or I didn't say earlier, but I'm saying now, all bonds are not created equal. If you have a bond that matures in 10 years and interest rates go up, let's say, you know, right now you can get about 5% on a bond like that. Let's say interest rates go up and in the future people can get 6%. Well, if you've locked yourself in for 10 years, that bond's going to go down more in value than if you had just locked yourself in for 1 year. Why? Because in 1 year you get your money back and you can buy a new bond at that 6% rate. So if interest rates go from 5 to 6% on a 1 year bond, in theory you've lost 1% because that's all people have given up by holding your bond for the next year versus a 6% bond. But in a 10-year bond, people have given up close to 10%. Now you have the time value of money, so maybe it's only 8%, but in a 1 year bond you might lose 1%. In a 10-year bond you might lose 7 or 8%. It's called duration risk. The longer people are stuck with a bond that's paying a lower rate than what they can get today. Think about people that locked their money in on a 30-year U.S. Treasury. Are they going to get their money back? You better believe they're going to get their money back, because the US government can print money. So they will pay back that bond. But the question is, that bond that they bought during COVID, when interest rates are super low, now people can get a higher interest rate. So they could be down 15 or 20% in that guaranteed US bond. So that's another way that people can get hurt. Another is credit risk. There are companies that are not that credit worthy, and they have to pay a much higher interest rate because people are worried about getting back the money they invested. So instead of paying the 5 or 6% that most credit-worthy firms might pay, big credit-worthy companies might pay for bonds, they might have to pay 10% or 15%. And while it may feel good to get that along the way, if you don't get your money back eventually, let's say you just get 2 years of interest payments or 3 years of interest payments, you can lose a lot of money. So I say the 60-40 portfolio is dead, because not all 60-40 portfolios are created equally. And so it's not just years of bonds, but it's the quality of the bonds that are inside of the portfolio. And then the last reason that I say the 60-40 portfolio is dead is it's not just one size fits all. You and somebody very similar to you, from how much money you've saved for retirement, for what your age is, for what your health is. Just because 60-40 might make sense for that other person doesn't mean it makes sense to you. And you've worked hard your entire life. You've sacrificed to save money. So just saying 60-40, just saying that that's a rule of thumb as I approach retirement, I'm going to be half in stocks, half in bonds, or I'm going to be 60% in stocks, 40% in bonds. That's a risky approach. You really want to look at your unique situation, what your requirements are for money, what your risk tolerance is. And speaking of risk tolerance, if you're still working, just a heads up, as a financial advisor, one of the things that I've seen is people's tolerance for risk, the pain of a 20-30% correction in the stock market is going to feel very differently once you're no longer working than it does while you're working and you can still put money in. And it's going to feel different for two reasons. You may put yourself in a situation where you're a forced seller in a down market, meaning once you quit working to fund your living expenses, you may have to take money out of your retirement accounts. Now, you could take that out of bonds, as I talked earlier, but some retirees are 100% in the stock market, or even if you're 60-40, if you want to keep it balanced at 60-40 all the time, what that would say is for every $1,000 that you need for living expenses, you're going to sell $400 worth of bonds and $600 worth of stocks. That if the market's down, you are now a forced seller in a down market. So the third reason that I say the 60-40 portfolio is dead is because we're all different. And you owe it to yourself, you deserve to have a professional look at your account and come up with a game plan that's tailored to you and your unique situation, and to have conversations like this so you're not caught off surprise. Better to hear today that your tolerance for losing money may not just increase 20 or 30% once you're retired. It could increase 10x. And instead of causing you a mild level of worrying, it could cause you what I call angst, acute worrying, to the point where you can't sleep at night. And maybe you don't even need the money, but you just can't stand the pain of seeing your account down. And so for mental reasons, you become a forced seller in a down market. And that's what we're trying to avoid. The other thing is, if you're married, it's typical if you're doing your finances, one spouse typically manages the money and the other spouse, does other things, right? So there's this separation of responsibilities and duties. And I would argue that it's good for both spouses to at least occasionally have a check-in with a financial advisor. Nothing what I'm sharing today is financial advice, but have that check-in for both spouses. And if something were to happen to the spouse that's managing the money, does the other spouse want to be the one taking over that role? In many cases, no. So having that person lined up, even if you're not working with him or her directly now, just so you know that if something happens to the health of the spouse that's managing the money, or they pass away or can no longer do it, they know who the baton is going to be passed to. That will give you peace of mind, extra sleep factor. And the other thing is just, we've been talking heavily about the financial side of retirement, but there's also the qualitative side, the feeling side of things. And that's why I made this video up here that talks about why retiring at 65 can be a big mistake. Thanks for watching this video, and I'll see you in there.